Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, I have David Foster, who is a qualified intermediary and most recently released the book Lifetime Tax-Free Wealth, the Real Estate Investor's Guide to the 1031 Exchange. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Thanks for joining us, David. Can you start by telling the listeners a little bit more about yourself and what you do?
It's great to be here, Gary. Yeah, I'm a lifelong real estate junkie. You know, I come from a line of Kansas farmers that settled on the land and homesteaded land 200 or 300 years ago. And I realized through the course of my life that there's really just two sets of people that have always ruled the world, the bankers and the landowners. And I'm too lazy and too poor to be a banker. So I decided to become a real estate investor. And I've loved it. I've invested in everything. And it's a party to me, putting deals together and figuring them out. So I've done just about every kind of real estate investing there is. Right now, our main game is, besides our own stuff, is that we act as a qualified intermediary, as you said, for other investors wanting to avoid paying tax on their profits through the 1031. So it's great to be here with you.
Yeah. Well, let's talk about the basics of a 1031, because I think people get confused. They hear a lot of different things. So let's start there.
Yeah, at its simplest, a 1031 exchange is simply a codified process that's been in place in the statutes for over 100 years that allows investors who own investment real estate to sell that real estate and, using the process, purchase new real estate and not have to get into indefinitely defer payment of the tax they normally would have had to pay on either the profit or the depreciation recapture of the tax write-off. So basically, you're getting to keep the tax dollars and use them for yourself. And people go, well, why not just pay the tax now? I mean, I hear that all the time. Well, let's say you had a $30,000 tax and you wanted to keep it for yourself using a 1031. So instead of paying it to the government, you kept it. You make 10% on that money. After 30 years, how much money do you have? Over $100,000, simply because you didn't do anything except keep the money going for yourself. That's the beauty of compounding interest. And that's what the 1031 lets you do.
Yeah. And so I think you, correct me if I'm wrong, you have to identify 3 properties within the first 30 or 90 days, and then you have to close within another 90 days thereafter.
Yeah, the time constraints are always what scares people to death. Fortunately, they're sort of like one of those corporate training events. The actual fear is worse than the reality, but they're still there. Yeah, from the day that you close your sale, you only have 45 more days to identify your potential replacements. You have a total of 180 days to close. Now, 180, that doesn't feel so bad. 45 can feel very scary until you stop and you think, well, wait a minute. I've got all the time before my sale closes to also shop around. So if you go under a contract for the sale of your property and you're in a 45 or 60-day close, that's another 2 months. So you got 3.5 months to find a property. And honestly, over 90% of our clients, even in this environment where it's such a frantic market, are still finding good replacements. So it's something to be cognizant of and to be focused, really focused on where you're wanting to go and what you're wanting to buy. But it's not necessarily something to be scared of.
I hear of people that they overpay, they get into bad deals because I guess they're not taking advantage of that time before they close on their deal that they're selling, or getting an extension, so they're kind of forced to get in a deal they, might not be the best deal for them.
Yeah, you know what? Extensions are awesome, contingencies. I always tell clients the thing you want to do is tell me what the hardest part of this is going to be for you, and then do that hard thing first. So if the hardest thing is finding a new property, do that first and get it locked up under contract. Then sell your old property. Oh my gosh, we were doing so many exchanges for your neighbors over there where they would wait to even list their property till they had a contract on their new property. They'd list their property, get a cash plus offer for a 5-day closing. But the hard thing was finding the new property. So take care of that first. As we move into a buyer's market, then selling your property is going to be tough. It's going to be the hard thing. So list the property, get it under contract, and then go find your own property. Take care of that hard thing first, and you'll start to mitigate a lot of that angst.
I love it. I love it. So I do real estate syndications and multifamily, and we get approached all the time for people to do 1031s. We have a minimum because it is a lot of work and money involved and whatnot. So we typically have a $750,000 minimum. I know there's a bunch of people that have come to me with like 75,000, 100,000 of 1031 money, and I say, hey, we still have cost segregation. You could take advantage of that way. I'm not sure how many deals there are out there with that kind of amount of money, but talk to me about some other solutions for people that are looking to kind of, defer their taxes and utilize the 1031.
Yeah, don't they call it the lazy 1031 exchange, right? And what they're saying is, let's just sell the property and pay the tax, because you're going to use your cost segregation and whatever bonus depreciation you might have to offset that tax in that first year. And by the way, I love that. What an awesome sort of strategy. But I am a pathologic tax hater. And so when you say just pay it once, I'm like, no, there's got to be a better way, right? So what this all keys on is the fact that as part of the 1031 exchange, the taxpayer for the old property has to be the same. You have to be buying actual real estate. And when they invest in most syndications, what they're buying is not real estate. They're buying a membership interest in an entity that owns real estate. So it doesn't qualify for the 1031. So you're absolutely right. One way to do it, lazy man's 1031, it'll work. But when that property is sold, you're going to face the tax again. Or you're going to roll it into another one and keep it going. But at some point in time, you're going to pay that tax. Now, if you'll remind me, I'd love to end this with the 4Ds of 1031 investing. So let's remember that. So what could be better than that? Well, if you've got the ability, which you do in your syndications, to sell the investor a tenant in common portion of the actual real estate. So they're selling real estate and they're buying real estate as a tenant in common with you. That works perfectly. Like you said, the problem is that's a headache for syndicators. It's no joke. Everybody says, how can you charge that much? Well, because it's a mess. Because you've got to have the lenders involved and everybody, the operating agreement. So, but it can be done, and we are seeing it. Yeah, $500 to $1 million minimums, and that's not as uncommon as it used to be. So that works as well. Here's a couple other ways. First of all, And I don't even know if you've seen it. We were moaning before the show about the lack of deals that are out there. But one of the things that syndicators have forgotten up to now is that they have the opportunity to do 1031 exchanges themselves. So when you've got a project that's gone full cycle, if you already have your next one lined up, you could 1031 exchange into that project. Now, when you do that, what happens is everybody who's a member of that entity has to go forward. Now, a lot of your investors kind of want to get paid. They just want to walk on down the road. So what you can do is you can buy them out of their membership interest. That lets them leave. They've got their own tax consequence, and your syndication goes forward. Now, what I love, there's a couple of syndicators whose eyes just went wow when they realized this, that lessens your fundraising goals immensely, because you've got a group of people who you've proven yourself to, who want to go forward with you. Fundraising, capital raising for this becomes really easy, and you're providing them tax deferred dollars as you go sale through sale. So doing it at the syndication level can be a really good thing. Now, there's one other way that I love, and that is to get the best of both worlds. So I want to defer tax. I'm not going to pay tax. I hate paying tax, but I've got this property here that I need to sell because appreciation is tapped out. It's going to need a new roof in a couple of years. It's time to sell it and find the next project. So what I'm going to do is I'm going to 1031 exchange. And let's say I've got a property that I'm selling for $500,000 and it's got $200,000 in debt. Well, I have, by 1031 rules, I have to buy $500,000 in replacement real estate using all $300,000 in cash. So what I'm going to do is I'm going to take $250,000 of that, and I'm going to buy a property free and clear, small rental somewhere, but it's not going to have any debt on it. I'm going to take the other $50,000 of proceeds, and I'm going to buy another $250,000 property with debt. So all of a sudden, look at what happened, Gary. I just protected myself from a recessionary event. I've got a property I can't lose. I also kept all my tax deferred. So that's a big bonus. And now, because I concentrated my equity, I come along and Gary says, you want to invest in my project? I'd love to. You know what I'm going to do? I'm going to pull a refinance off the free and clear property. And then I take that free and clear $200,000 and I'm going to invest that with you in your syndication. So I still deferred all my tax, but I managed to access the equity that I need to go into the syndication. And we're starting to see a lot of people do that because they've got that much equity, but it's all spread out if they keep 1031 it. So we help them to concentrate that, and then they can invest with you because refinances are not taxable events.
What are the costs? Typically, the person that's doing the 1031 exchange into a syndication, into a TIC, is paying for that. So, for listeners out there that are interested in doing something that, let's say it's $1 million. What are those costs that they're going to endure for that?
Well, all of the costs on the syndication side are really going to be unique to the syndicator. So, and I very seldom get into that with them. For us, it's more a question of syndicator calls us and says, Dave, meet Dan. They want to do this. Can we make it work? That kind of thing. From the 1031 perspective, there really isn't any additional cost because the 1031 doesn't care what you're buying as long as you're buying real estate. So for $1 million 1031 sale to then reinvest, you're looking at, for us it'd be $950. You're looking anywhere from that to maybe $1,200, $1,300 for their noise level for the power that you get.
Yeah.
So that's, yeah. Does that answer your question?
Yeah, absolutely. And I've also heard that there's a decent amount of percentage that things go wrong when you're doing a 1031. So let's talk about those things that could go wrong so that people are aware of it.
Murphy's Law raises its hand, right? Well, yeah, what could go wrong if you're left to yourself? The qualified intermediary that you have to use, that's required by law, needs to be your guide. So if they're not with you every step of the way, informing you of, does this count as investment real estate or not? Are we meeting the timelines? Are we making sure that the same taxpayer who sold is the taxpayer buying? Are we making sure that it's going to qualify for this syndication? Are you meeting your reinvestment requirements? All of those things are what you've got to have that guide for. So what do I see that's most common? The reinvestment requirements are the toughest thing to understand because everybody thinks, I'm going to reinvest my profit. I just want to take my original capital back out. The problem is when you sell, the IRS says that any dollars you take out or any amount you purchase less than you sold, you're taking out profit first. Now that's just a nasty, that's dirty pool. But they're saying that. So you and I want to say, no, that 100,000 is my money. It's not profit. The IRS says, nah, you're leaving that in with the 1031. You're taking out profit first. So that could really catch people. So that's probably number one. Number two is the 45 days. Most definitely. Everything else, you've got a nice window of time to overcome. But just about 95% of the exchanges I see fail because they're not focused enough on where they want to buy and what they want to buy. And so they get too many choices. It's like being in the candy store. You knew you wanted licorice when you walked in, but as soon as you walk in, there's too many choices.
And how could someone, what are some of the things that when they're looking for a qualified intermediary, what separates a good one from a bad one? So, person out there is trying to find someone. What should they be looking for?
Yeah, let me give you the scare first. So by statute, you are qualified to be a 1031 qualified intermediary as long as you are not related to the party with either a business or family relationship. So you could be a QI for some stranger down the street. So really putting out a shingle and saying I'm a QI, the bar is a little bit low at that point. So you definitely want to do a lot of underwriting and vetting of them. Now, that being said, don't be scared because this is like being a qualified intermediary is like diving into 2 miles deep in a 2-foot wide creek. That's all we know. That's all we do. So we're nerds of the first order. And the only kind of people who generally go into those are accountants and attorneys. I'm the lone accountant in our firm. So I'm the redheaded stepchild. Everybody else are attorneys. So I keep my door locked. But that's what you want to look for is the type of ancillary experience as an attorney to understand the real estate industry, as an accountant to understand real estate taxation. And then definitely you want to find one where this real estate cycle ain't their first rodeo. Everybody and their mother has made money in the last 10 years. So everybody's an expert, right? No.
Yep.
Go through 2008 and then come and tell me if you're an expert. It's going through full cycles, just like for you guys, taking a project through full cycle is what makes a good syndicator. Simply being able to buy a property and raise money doesn't say anything about your ability. So going full cycle through real estate cycles is really pretty key. And then even the best QI in the world isn't going to be worth anything to you if you can't talk to them. If you're just talking to a VA or an order taker or a junior assistant without the answers, you're going to be led wrong. So those are my first. And then I guess lastly, everybody wants to know about security of funds because the main rule of 1031, you can't touch the money. Well, that's scary by itself. You mean I'm going to give you all my money? And I laugh because in general, it's the people who are giving me the funds off of a $100,000 sale that are scared of it the most. And I want to be polite. But part of me always wants to say, if I was going to take somebody's money, it would be this other guy's 5 million, not your 100,000. But how do you protect from that? Even the best insurances in the world are only good if a bad event occurs. So what we started doing, which is unique in the industry, but we got private letter ruling permission from the IRS, is that we create separate accounts for every exchange, and they are in the name of the exchanger. So money cannot move into or out of that account without their signature. And that protects them from us. Now, they're set up so they're dual signatory, which means we also have to sign when money leaves. And that's what protects them from the IRS. So it's a nice system. But yeah, experience, availability, protection of the funds.
Let's spend a minute on DST's, Delaware Statutory Trust, where I know it's the way I understand it is it's a little bit more expensive. You have a little bit more time. But maybe you could kind of explain the difference a little bit better than I can.
Yeah, the DSTs they're basically just a syndication, but they're held inside a trust fund, a trust that's been set up in the state of Delaware. And the only difference between them and a syndication, there's really two. The first one is that they've been specifically blessed by the IRS to qualify as 1031 replacement property. So remember, buying a share of a syndication, limited partnership, doesn't qualify. You're not buying real estate. The IRS said in 2004 that buying a share of a Delaware Statutory Trust counts the same as buying real estate. So you can sell an apartment complex in Omaha and buy a Delaware Statutory Trust percentage of an Amazon distribution center in Austin. So it acts just like real estate. So it's actually very simple. You've got the same 45-day identification period, 180 to close. You sell your property, find the DST you want to buy, boom, you're off to the races. Now, the other thing that makes DSTs not so attractive is that because of the way they're set up, everybody has to be treated equally. So there's no way to give your investors any sort of preferred return, first return, anything like that. Everybody's in the same bucket, being treated exactly the same. So for a lot of people that like to go into syndications where they get some preferential treatment or some first out of funds and that kind of thing, or where they want to go into something where you may have set it up so that you don't get paid until they start getting paid. Those kinds of things can't be done in a DST. Everybody's created equal, but they can be a great hedge because they continue the deferral. And the most beautiful thing about them is when they're sold 3 or 4 years later, you just 1031 back out. And maybe by that time, interest rates have corrected, the buyer-seller imbalance is corrected, and you can find some bargains to buy. Or you dive back into another DST.
All right, David, you mentioned the 4Ds. Let's hear them.
I'll give it to you as a test. So there are 4Ds that really constitute the entirety of 1031 investing. The first one is defer. Makes sense because I'm going to make compound interest work for me. And whether it's one day or whether it's 30 years, every day that money's in my hands, it's making money for me. So I want to do that. The second D, any idea? I'll give it to you. It's defer. Because why? Because I can use the 1031 to navigate any real estate cycle. Do I own in Los Angeles and appreciation is finally starting to stagnate and I want to go buy maybe in Austin, follow Elon there so I can catch that wave? Perfect opportunity for a 1031. How about investing where appreciation is stagnated? I 1031 into cash flow. As I grow, I want to go from single family into multifamily, 1031 exchange. Any type of real estate, anywhere in the country of any number. So you can sell one, buy two, sell two, buy four, sell 16, and go buy one really big multifamily replacement. It ebbs and flows the entire way. So the 1031 will work in any part of a real estate cycle. What do you think the third D is?
Hit me.
Defer. Because I know you're sensing a trend yet, right? So defer not only where the 1031 doesn't only work with the real estate cycle, it works with your cycle as a real estate investor. When we're young, we got all kinds of energy, we got no money. We get our first property and we're going to fix it up, aren't we? Because we love to swing a hammer. We start to do value adds and all that kind of thing. And then when we sell, we can sell that one and go buy two. And then we're going to value add those because we're using our energy to our advantage. As we start to get a little older, we start to have more money than energy and time. So we use our money to maximize our time by 1031ing into different types of projects where we can generate better returns or where we can start to go from active to passive. This is where we can do the cash out refinances and start to invest in good syndications. I've had great success with that myself. I actually love that. We can also start to aim towards retirement because people might want to manage their own portfolio, but they're going to retire from Cincinnati where it all is. Well, ahead of that, why don't you go 1031 exchange your Cincinnati properties to Sarasota? And there your portfolio waits for you to retire and come down. But here's where it's even crazier. Because it's possible to convert 1031 properties with deferred gain in them into your primary residence and not pay the tax. So what that Cincinnati investor does, they sell their Cincinnati home. That money's tax-free under Section 121 of the code. They're going to move into one of their really nice vacation rental properties. And as long as they live there, they'll never pay the tax. So you can accommodate this all the way through your life cycle and the cycle of real estate. Okay, the fourth D, I give it to you because I know we're running late.
Sure.
It ain't defer, it's die.
All right.
And it's not my favorite one, but we're all heading there, right? When you die, your heirs get a step up in basis. So they inherit the property as if they paid market value for it. The tax literally does disappear. So to all those naysayers out there who say you're going to have to pay the tax anyways, my answer is no, you don't. Even if you did, every day is the day the dollars go into your pocket. But if you play the 1031 game throughout your life, you will do nothing but generate tax-free dollars, and you will die and your heirs will get the money tax-free. Yeah, it's the power.
Yep. Excellent. Well, David, you've been a wealth of knowledge on 1031. So thank you so much. Where can listeners find out more about you and your company?
Best thing you can do is to go to our website, which is the1031investor.com. I'm sure you've got that in the show notes. We have a part series on our YouTube channel, which is Dave Foster 1031. We've got calculators, opportunities to talk to us, because the best 1031 investor is an educated 1031 investor. You can get your book on Amazon, and all of those things we talk about, the tricks and tips on how to invest using 1031 throughout your life, are all found in that book, along with a lot of fun case studies from people that have done it.
Awesome. Well, I appreciate it. I'm sure our listeners appreciate it. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.